What is going on, and welcome on into today's stream on this slow bleeding Friday. As it looks like, we are looking at the S&P, which is currently down 0.6% on the day, just tagging 410 as we speak. And that does kind of mean, it's breaking down below this, or at the bottom of this volume node. We'll cover a couple things here in this video that I think are interesting. We can look at this chart and we can start to say, this is getting pretty extended to the downside. And we had a decent bounce from 420 back to almost 440, so like a $15 to $20 bounce. And that occurred after the S&P dropped from 450 down to 420, so a $30 drop. I guess percentage-wise, you can call it about a 7% drop. From that recent high that we put in around 437, whatever it was, on this little bounce back, we've now dropped about 6.5%. So we're almost at the same, percentage drop. So it's getting overextended, I think, to a decent degree, especially after the past 3 days of just pretty nice continuous downside pressure. So we'll see if that means we're going to get a bounce. Doesn't mean we're going to get a bounce, but you'd want to start thinking that way, I would think, given that. But of course, anything can happen, like always. We'll cover the bond market. We'll cover a bunch of different things here in this video. But we can see, though, that even though that the S&P is technically down, the NASDAQ is actually up today, technically. Looks like an inside bar day, meaning the entire day's price action today will be inside of the entire range of yesterday's price action, unless something crazy happens into the close. And the NASDAQ is currently up 0.4%, which is, okay, cool. Here's where the Russell yesterday was strong. Now it's back weak again. And so it's it has definitely been a better swing short environment versus trying to day trade that relative strength and weakness. It is at a new low of the week. We were looking at this one, end of last week, it's breaking down. It did. I ended up getting out of my short earlier this week, just because I just didn't like how it was bouncing and it was not continuing to see the relative weakness that we were getting. But to a degree, faked out. I guess I could have held on to it. But I still got and achieved the targets, or at least the first targets that I was looking for. But now it is making a new low. This is a new low on the Russell today for the entirety of the bear market. So the Russell, has it bounced? How much has it bounced back on some of these lows to highs? It did have a 23% bounce. So is that technically putting you back into bull market territory? I guess. I don't know what the true official words are, the official classifications, whatever. But technically speaking, this is making a new low, which is interesting. We zoom this thing out and you look back past couple of years, volume profile wise. Let's see when this resets and reloads. I think we have a little more room of downside. I believe there's a pretty nice volume node in the 150 something range. Give it a second to load up. Yeah, this area right here. So down, once you get under 160, down towards 158, but then after that, there's a pretty nice volume node. So we'll be watching that one pretty closely on the old Russell, but it's really going to take some time. I don't know. Just like if you were to, I'm not a Bitcoin, I don't focus much about Bitcoin, but if you look at Bitcoin, you're not going to see the crazy explosive altcoin movement until Bitcoin probably gets a lot higher and sustains a move for a while. So kind of the same thing here. I would suspect that until the S&P, establishes much better footing, I don't know if the Russell is going to it's going to catch on. So yes, could it be a better, it could bounce back more, but at the same time, if the S&P kind of bounces and rolls back over, this could be kind of in a downtrend for longer. Now, that on an investing side, I don't think matters, and I think it's actually a much better deal. But if you're trying to trade off of it, you probably aren't going to see a lot of strength, I would think, in the Russell. You're not going to see that until the S&P establishes better footing. That's just my 2 cents based off what we've seen. But, of course, anything can happen. Reporting from Laguna Beach. Russell's collapsing. What's going on, Flippa? Yeah, no, here's the thing. This is going to be, from a number perspective, the past couple of months, this will be my best month trading wise. Nothing insane, but it will be my best month number wise in a while. probably since maybe maybe May, maybe June. I don't know, somewhere in there, since the early summer. But the reality is that I don't feel like it is. It doesn't feel like it should be. And it's like they're honestly, I have not been shorting very much intraday. I have not been doing it. The only shorts that have been working really nicely for me have been swings. And by the way, look at mRNA. We were talking about mRNA. I had swung this short from a couple weeks back, and I was looking for a nice breakdown, a $10 move, risking $5 in case of a back test. And the thing is gone from 95 to now under 72 in a span of like 2 weeks. Absolutely massive move down. And that could have been a swing. Now, the thing is, like, this move, I mean, holy crap. That's nothing on this chart anytime recently suggested we would see that at all. But you broaden it back out. Are we surprised it's happening? Not really, which is kind of why I do like the swing approach, where you can size in accordingly. You don't have to size huge. Size in accordingly and let it work per time. Now it's coming into a volume node, so yeah, okay, sure. What I'd like to see it do is it kind of bounce back, consolidate here, and then if the market stays weak, then you get the next leg down into here. I mean, that's a massive move. I don't want to get ahead of ourselves, but I think that that's very doable. I think that that's possible. Either way, I played the breakdowns here and got 10 points within like a week, a couple of days, and it's gone so much further from that, which is nuts. It's gone like $25 almost from my entry, which is nuts. So like that's the type of stuff that's been working good. But the intraday, it hasn't been. I mean, like, look around. Like, look at the S&P. Look at some stocks today. If I go to my trade list, you'll see that obviously Amazon had earnings. But on a day where the market's down, I guess the Nasdaq's up. Okay, the Russell's down a lot. S&P's down, decent bit. You got a stock like AMD. If you go to look some of these 5-minute charts, you got a stock like AMD that's up almost 3%. So it's like, okay, that's not really a short. You got Meta that's now up 2.5% today. So you're not getting a lot of consistency. And what I have found is that on the short side, through tracking my own strategy and stuff, you're better off when most things are aligned, right? And so despite the S&P, the Dow, the Russell, right, and even the Nasdaq generally all being down the past, couple weeks, inside of that, the stocks that I would trade are not all just going straight down, right? You've got, on a given day, some will be red and then some will actually be green. And it's kind of like they kind of flip back and forth. And that's what I've been seeing, which just means to me, there's nothing wrong with that. It's just, it is what it is. But to me, it's just a time where, okay, that's the environment. Is that a high probability environment for me to trade in? No. So I just really haven't been doing much, I feel like, but it's not a bad thing. It's not a bad thing. There certainly are little opportunities, I'm sure, but I haven't seen anything that's super nice, super, super clean. And even if I look around at some of these daily charts on the downside, let's just start taking a peek. Here's Meta's daily chart. Does this look appealing to me at all to short or to long right now? No, you're in the middle of fucking nowhere. Like, what is this? You're literally right in the middle of, like, I don't know. You've got a bunch of lower wicks down here and you've got highs up here. You're literally in the middle of that. So it's like there's not really much incentive to me to play that either way. Amazon just got a lot shittier. Amazon was breaking down. Of course, it had earnings. Now it's back up into this consolidation. So it's like, okay, well, that's kind of back into just chop city. So you're kind of waiting on that. AMD has been more of a trend to the downside, but now it snaps it back up a little bit. So yeah, maybe it's closer to lows, but okay, look at this. Look at the nature of this past move, though. It has not been. It's like up, down, up, down, up, down every other day, right? So it's not very clean. You're not getting momentum to flow behind that. So you have this, what I'm essentially calling a slow bleed, is that things are generally trending down, but it's not like an aggressive move down that we have seen in the past throughout, I guess, last year. Even go back to like around this time last year. You saw a lot more aggressive moves to the downside in September, October. Of course, that was the bottom of the market. And so you had peak fear, peak panic, all that stuff. But, you know, so it's kind of this like middle ground. And I think it's a really good and learning experience and environment to be in, because the reality is that this is kind of where the market probably lies a lot of the time, even on the way up too. It kind of lies in this middle ground. And so you don't always get explosive moves up or down, and you kind of have a lot of this middle ground. So that's kind of my take on what we're seeing. And I think it's good practice to understand, like, you've got a lot of opportunity, a lot of time, but there's no reason to push pace, which also leads me to believe that when the market cools down, and it has, I think right now, that's why I like swings. I've liked looking at the bigger time frames so much better, because that's where you'll see those, you'll be able to zoom out on those moves. And then you'll be like, okay, I'm not playing for a $2 move. I'm playing for a $10 move up or down over a X, period of time. Could be a couple months, could be, usually I'll play it out to the next, I'll give it like the time frame until next earnings, because I won't hold through the next earnings. So if I'm looking for swings, like, yeah, AMD's got earnings coming up, no swing there. Like, no, that's dumb. Any stocks that have earnings, that have already just had earnings, now get added to a list of like, okay, these could be valid swing opportunities if a pattern or the chart's set up. So that's what we got. Looking at the 10-year, it is technically it's down, but it's pretty much flat on the day. So not much movement there. I thought maybe we'd see something, either it's going to snap it back or it's going to break down. Not much clarity there, at least today. Didn't get much opportunity this week. Yeah, it's just, that's how I kind of feel. I look around and like the mRNA was a kind of a big, I don't want to say a big miss. It was a good trade, but the continuation there was huge. There was more on meat on the table that I guess I left. Didn't realize that. XBI, I think, is it's coming down to new lows of the year here as well, I believe. Yeah, that we were talking $62 on XBI. This is the biotech ETF. That's the spot to be kind of watching for, bounce area. It's getting closer and closer to that level. Now it's like kind of right in the middle of this band that has been prior support, since 2018. So I like the look on that for sure. But it's definitely a waiting game. It's a patience game. You can't just expect that to bounce tomorrow. And it's just more of an investment kind of game. Sit back, leave it alone, and just allocate some funds to it and leave it. Let's see. There it is. Coinbase. Here's a swing idea that I have. I'm curious people's thoughts. The only problem that I have with this, and it doesn't necessarily, I think this is actually valid, because Coinbase has earnings. It would be a shorter hold, or it would be the earnings is going to be your time expiration on this, November 7th. So that's not next week, it's the week after. So you have about a week and a half roughly on this. Now, concern, yes. Is it breaking this trend line? Yes. How valid is that trend line? I don't know. That's kind of the true level, is right around 69.50, and it's still not there. But if I had an idea of like what I think could be a decent trade opportunity, it could be this, because you had this big upper wick that sells right back off, and it starts to drill right back down into the bottom of the consolidation. And you've got a nice volume profile gap down to about, the lower 60s, and you're currently in the lower 70s. It's about a $10, move. So it could be an idea. Now, how would you risk that? It's kind of, weird spot in my view to risk. So that's where I kind of draw the line. I'm like, I don't think it's worth it. But either way, could still be worth it next week if we wake up and Bitcoin, how it depends on how Bitcoin does this weekend. The reason why it kind of sketches me out is because, you had this Bitcoin move up here. Bitcoin still looks pretty good. Like, it looks strong. Of course, does it mean it have to hold? I don't know. Who knows if it's going to hold. But if Bitcoin does give this back, totally a Bitcoin type of move, right? Pop it up and then give it all back. I mean, Coinbase is going to get slashed. Coinbase is going to get nailed if that happens, based on how it's been performing. So you look around and say, okay, interesting, based on what we're seeing. But you're making a bet that Bitcoin breaks down further, or not further, Bitcoin breaks down and gives back a chunk or all of its recent rally the past couple of days and the past like week and a half. And then that leads to Coinbase pulling into here. Now, it could make sense. And based on the market environment, based off the risk on like market, like it would make sense that Coinbase breaks down here. But again, it's an if. There's no guarantees by any means to that stuff. $62 is Kershaw XPI IWC. How does IWC look? I would check out, honestly, on some of these. Here's my thought. Like I would be looking at, and I honestly might consider it too. I might not be a bad idea. Not that I have any like tech exposure, really, I guess. If I want to sell BITO, I could. But I'm saying like, I could sell BITO because now I have Bitcoin exposure. So I could do that. But I'd be looking at a small cap or a micro cap income ETF right now. Because, yeah, it's a shitty time for these sectors and these stocks. But that's a time that, like, set up a recurring investment or just buy a chunk and then have the dividends auto reinvest, and you'll get paid dividends, I mean, legitimately every month on those income ETFs. So that's why I think those are interesting right now, because you're there for the downside in those income ETFs. But when the downside's already been occurring for a while, you know, you've at least missed out on a lot of that loss, and you're jumping in now, and then you're getting paid dividends, and then you're getting those dividends reinvested back in. You know, if it does keep going lower, let's slowly accumulate a lower average, little by little. And then you're there for months to years in the future when the thing eventually appreciates or whatever, goes back up. You've been getting paid dividends, and it's a cash flow vehicle that entire time, which is kind of nice. So that's kind of what I would look at is, yeah, of course, just the ETFs are fine, right? But from like an income standpoint, because I come from much more the approach right now, especially with how real estate is. If you can get cash flow, like the market is probably the best place to get that recurring cash flow without ridiculous investment. And of course there's a risk, yes, but is there as much risk in like a sector that's been getting absolutely annihilated like this versus real estate, which you can even look at these charts and go back the past couple of years and say, okay, IWC, which is the micro cap ETF, is back to pre-COVID levels, right? So yes, the market can come down further, don't get me wrong, but we are absolutely nowhere fucking close to pre-pandemic levels in real estate. And will we ever get that? You will need an absolute crash to see real estate back at pre-pandemic levels. No guarantees we get that. We could, but we could also see a scenario where real estate just doesn't appreciate maybe for the next 10 years and incomes slowly catch up. And we kind of have that curve of like house, and then rates come down a bit where it's like housing costs versus incomes is like not like this. It's like back to like this, you know, that could happen in the next 10 years and you never got your crash. You never knew when to dip buy, versus you can kind of look at these charts and say, okay, well, like the valuations in microcaps are back to where they were in 2018, 2019. Yeah, they can go lower. In COVID, they went much lower, but that was a temporary pullback. And, you know, we knew what happened after that. Either way, I kind of can see this chart, look at it and say, hey, I can get cash flow. Even if prices go down, I'm going to put my money there. To me, like that's the play right now. So I would, if I was looking at stuff, I would definitely be looking at like, I don't know, biotechs, small caps, micro caps as well. Not like individual stocks, sectors. I do not like individual stocks on those things because you can get destroyed in that stuff. It's a terrible idea. Unless you know what you're doing from like a swing trade strategy or like a trading strategy that you've built. But other sectors, let's go look at other sectors too. Let's go through the sector list. XRT is retail. Give these charts a second. I'll pull up the weekly charts because it's nicer to look at like the bigger picture. Give it a second to load up. This thing looks like a bear flag to me, but I would be looking more at like, let's see, XLV healthcare. I gotta refresh this. Give it a second here. Healthcare, I believe, is, yeah, look at that bottom of the recent consolidation. You want to be looking for weakness is all, as you know, we're looking for here. So let's go look at XLV. Pop up the weekly charts here. There we go. Not as nice because it's just been more of a consolidation versus more of a pullback in healthcare. XLU, I believe, yeah, like XLU is an example. Like the past couple of weeks, so right, this has been a decent potential dip buy opportunity. Here's the real estate, which it's coming down. Don't get me wrong, XLRE, but that doesn't necessarily mean that real estate prices. It's more so a real estate ETF, what goes into that ETF and stuff. XLP, XLF, yeah. I mean, when you look around, man, it's just like biotech stand out. Biotech stand out a lot as a place that, again, it's a time that no one wants to buy it. Biotechs, small caps, and micro caps, like no one wants to buy those things right now. So they stand out as like best dip buy deals, if you will. Of course, could get crushed if market gets crushed, right? Those will probably be the first ones people slam even further. But bottom probably comes faster in those, and then the bounce is probably more aggressive whenever that time comes. And so from a dollar cost average approach, these are sectors I think that offer much better risk reward right now than QQQ. I mean, look at QQQ's weekly chart. And then this is going back to 2012. Then go to XBI, the biotech ETF, to 2012. Right? Much closer to that 2012 spot here on biotechs than on Qs. Now, of course, different sector, different stocks, different way the world has gone, I guess. But, from a minimize the risk, that's my thoughts. And the thing with stomaching the volatility, that's why I like the income ETFs, because you can stomach the volatility because you're getting paid a dividend every single month. Like, that's the cool part about it. So it makes it so much easier. Let's see. Let me see. I wish they had a biotech income ETF. I wonder if they have one. What is this? XFIX is not a biotech. Opportunistic income ETF. That's brand new. XFIX. Maximum total return, blah, blah, blah. Identifying undervalued and opportunistic sectors and securities in the U.S. fixed income markets. Yeah. I wonder how that would do, but it doesn't have enough data behind it, so whatever. Either way, there was a small cap income ETF. Okay, here we go. DES, SMDV. Yeah, okay. I wouldn't do this. What's DES look like? I know I should have kept a list of this. DES. So, DES, right, is small cap dividend fund. Holding up pretty good, actually, to be honest with you. Obviously, it's down towards the lows. This chart looks similar to IWM, but it's not completely. It's not at lows yet of, I guess, last year. So it's holding up a little better. But look at these Ds right here. All these dividends. Now, problem with this is that it's a 3.18% dividend yield, so it's not huge, but it's not bad. 3-cent dividend every month, 10-cent there. We had a 7-cent, 5-cent. Okay. We want an income ETF though. That's the whole point though. That's probably dividend stocks. I'm sure we can probably just look up. I'm sure we can find one. Risk managed income ETF is NTKI. Okay, let's try that. What's that look like? No, this is not as well. It's not traded very cleanly or actively, but it will model. I would imagine the Russell 7% dividend, pays you monthly. Not terrible. 10 cents, 11 cents, 11 cents, 12 cents. They'll call it 11 cents. 11 cents a month on a $17 stock. You get 100 shares. It's about almost $1,800 capital requirement. That then pays you $11 a month. Nothing crazy, but it's, and just kind of, that's off of less than $2,000. Do the math on put in 10K, right? Adds up. So I don't know. You can put it in TLT. The thing is, like, we're talking like diversifying. I have money in TLT. I have money in TLTW, which is the income ETF off of that buy right strategy ETF. TLTW apparently is currently, based off of, I guess, whatever their calculations, is giving you a 19% yield. Obviously, it's been hit with TLT, but dividend here on October was almost 30 cents, 33 cents prior to that, 19 cents prior to that, 53 cents prior to that. So it's volatile, but nice chunky dividends, though. That's where I have money there already. I'm just saying, like, we're talking about from, this is a decent chart, right? Thing has gotten very oversold. The Russell looks much better than, if you were trying to invest in the stock market and you're like, hey, I want a dollar cost average into something, I think an income ETF for small caps or just into smalls, IWM, XBI, something like that makes more sense than QQQ. SPY is fine too, but better deals technically still in small caps. Dow, I guess, too, if you wanted to think of that way. Dow's gotten hit pretty hard lately, but holding up way off the lows. TLT, though, risk of TLT, though, too, which I guess risk is anything. TLT risk is that somehow the market and the economy handle rates this high, and we just happen to stay this high for, a long-ass period of time, and we never have a recession. I feel like that's pretty unlikely, but I guess it could happen. And that would be what keeps TLT low. TLT pays about a 3.7, almost 4% dividend as it is. Now, that will potentially drop as it goes up, if it goes up. That's why I like TLTW personally on that front. I like that one a lot. So I don't know. I think it's I mean, it's just it's an interesting time, but it's almost a boring time. But I think those income ETFs right now kind of shine because they at least give you some cash flow when the market's just kind of boring. And it's generally going down. I guess it may not be boring, but it depends upon where you are. Not everything is just going straight down. Some stuff's holding on. Some stuff is not. End phase is one of those examples of a stock that's not. End phase is at 81.51. Remember when end phase was back at like, almost $200 this summer? Yeah. Yeah. It's a long time ago. Feels like. I haven't bought end phase or anything like that, but jeez, thing is getting crushed. Massive run from 17 to 22. But yeah, it's not. I mean, who knows? Where I haven't followed them. Apparently, the earnings have all been pretty good the past couple of years, which is why it's held this move. But this last one, I guess, gapping down prior to earnings and then gapping down now on earnings. So here we go. An interesting one to have there and to watch. Oil stocks got hit a little bit today. I think some of them hurt earnings today. ExxonMobil back down to the mid to early October lows, pretty much at 105. I wouldn't surprise if this thing ends up, rolling over further, but you probably will need oil to do the same. When oil's actually up 2% today, which is interesting. Now, of course, Exxon's probably going off of their earnings. That's the move, but oil for now bouncing off of this spot right here. Looking decent. Silver's up 1 point. Oh, I didn't realize that. Silver's up 1.4. Gold's up over 1%. Oh, wow. Look at gold. That looks good. Gold looks pretty good. I'm falling back in this seat here. Gold does look good. Silver and gold holding up nice. What's the dollar doing? The dollar down? No, the dollar's just... I don't want to get that out of there. The VIX is at 21. VIX is holding up better too. Look at that too. VIX not spiking, but it's holding up much better with these higher lows as of late, which is nice, and higher highs. So that hasn't broken down. The VIX breaking back down here, like then okay, or not that. Breaking back down would probably be a better sign for, a bounce. We're just not getting that, or a sustained bounce. Not getting that right now in the VIX. So that's also pressure. GameStop. I still have my GameStop short. Still in that. Patience play there, in my opinion, but it looks good. Looks good. I have puts on it too. I had puts. Do I still have puts? Am I robbing an account? Oh, I do. I have one left. Out to next year. It's out to the 19th of January. So I got time on that. But next breakdown point will be right around this 1280 or 1290 area. On that, earnings is not till just mid-December, so 2 month and a half ish until I would be getting out of that. I think it'll still end up making its way towards 5, but we'll see what it does. We'll see what it does. Yeah, Bitcoin is in the middle of like, I don't say nowhere, but would like to maybe see a back test and bounce if it's going to hold. That's the problem with the Coinbase play, is like if you were to short or long Coinbase, like I do like the look on the chart for a short. I just don't think I would be, I can't hold it over the weekend. It just doesn't make sense to me. The risk is just not needed, because what if Bitcoin ends up, ripping up over the weekend and Coinbase opens up on Monday at like $80? It could. you know, and then now my risk was supposed to be 76, but then it's at 80 in pre-market, and now you know, so I don't know. I'll leave it alone. If it breaks, if hopefully Bitcoin doesn't move very much, or Coinbase doesn't move very much, and we can get a look at this thing next week at like 70, 69 area for a move down to the mid to lower 60s, cool. But if not, it is what it is. Just let it do its thing. But yeah, could not break 35K really at all. But look at that chart. That chart on the weekly chart looks pretty good. Looks good, you know? Looks pretty strong to me. I mean, it would be cool. It would be funny if it ends up coming right back down. It would be hilarious. That would be a Bitcoin thing to do. But I don't know. I sold a covered call on BITO, my BITO position, at the 1950 strike price. I got that for like 12, 13 cents on Tuesday, I believe. That's worthless now, so it's free money. I had an SLV. I have an SLV 23 call for next week that I sold. Oh, it's fine. SLV would have to go to here. That's far. In a week. That's pretty far. What did I sell that thing for? I got 7 cents for it. So $7. Cash flow is cash flow, I'll say. Couple bucks adds up. Do that enough. You know, it's like, why not pick up the $5 bill on the ground? You know, that's how you look at it. Of course, that $5 bill, as a portfolio grows, as position sizes grow, can become a 10, 20, 30. I guess no $30 bill, but 50, 100. Natural gas killing it here. Natural gas broke this like $3 area, came back below. It didn't look great, then snapped right back up. Kind of a wonky chart. Natural gas plays the USO. Well, I don't play with it anymore. Maybe I'll come back to it one day, but I've probably, like I said in the past, I've lost on natural gas trades. I don't have the exact stats, but it's got to be like 8 or 9 out of 10 that I've lost. Like, if I've taken 10, I literally have lost 8 or 9. So, not fun. Yeah, the Bitcoin thing is interesting because it if it ends up kind of decoupling from the market and stuff, it's kind of cool that it does. Like, if it's doing that, like if this thing ends up holding up, like look at this move, right? In recent weeks, and the S&P has done this down in recent weeks. So if Bitcoin can hold this move while the S&P shits the bed, that's pretty impressive. That's good stuff. Which is what you'd want to see, right? For Bitcoin, you just kind of want to see it do its own thing and not be tied to the S&P as tightly as it's been. So that's a good sign. Let's see next week. What do we have? Nothing for Monday. Not much on Tuesday. Oh shit, we got Powell on Wednesday? No fucking way. Really? Dude, that sucks. Yeah, oh god. They're not gonna hike him, right? Are they? Yeah. Wow. So next Powell meeting, right, is, well, that's a catalyst. So big catalyst on Wednesday is the Fed. Well, hopefully, not hopefully, we should be live for that. Yeah, we'll be live for that. So 97% chance that we keep rates at the current target rate, right? We keep them where they are. This bar right here, 525 to 550 BPS. 2% chance though that they cut. That's essentially none. This has been really good in predicting where we go, but looks like we're done, man. Go to December. Yeah, it looks like the Fed's probably likely done here. We'll see. Obviously, things can change, but that's on Wednesday. So that's big. And then Thursday, jobless claims. Fridays, non-farm payrolls, unemployment rate, blah, blah, blah. So kind of cool early. Big. Now, the thing is, I would say, too, here about this is that I really don't like. Now, maybe you sell off early. I definitely do not like the big move down into that. Like, if you were looking for continuation, I don't like that. So we've had a nice move down on SPY, right? Drilling pretty hard. Going into now Wednesday is Powell's Fed decision in his press conference. I don't like the look of that for a continued drilling short because I feel like that's the crowded trade. Could be wrong. That could be the crowded trade, right? Powell speaking, oh shit, everyone fucking gets scared and then is like, oh my God. So I would be careful about that. We'll see what happens on the backside of it, but wouldn't be surprised to see a bounce on the backside of it if we don't get one before. If we get a big bounce on Monday, Tuesday, then sure, all bets are off, but if we don't bounce big on Monday, Tuesday, and we're kind of hovering around 410, even 415, I wouldn't be surprised if we pull a further bounce after that. Let's go to fear and greed. What does that look like right now? This is currently sitting at a 24 extreme fear. So haven't been here a ton this year. Got down there in March. And got down there in early October. Go back to early October, October 3rd, we got 18 on the extreme fear. Go back to October 3rd, that was right here, and that was the bottom at 420 roughly, and then we bounced about $15 or $17 back up from there. So again, it's kind of one of those things of like, just be careful, because when we get down into these ranges, we have seen bounces, and that's a good reset to see a bounce. So there's that. AAII sentiment came out yesterday. This came in at 29% bullish, which is the lowest we've seen in October, and 43% bearish, which is the highest we've seen in October. You'd have to go back. Let's go back to some of the historical data. So 29, yeah, we did have a 27 bullish end of September and a 40, but this 43% bearish right here is the highest. I mean, that's the highest we've seen since likely March, which is kind of crazy. So what that tells me, though, especially as we've even seen back in October some other 40s popping up, is that we've got a good reset in terms of sentiment. Does that mean the market has to go up? No. We've got a good reset in terms of sentiment, whereas like people are bearish again. So that could be, you know, enough of the fuel for, I don't believe it's going to be, we're not going to bounce, blah, blah, blah. We're going lower, 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 which could fuel the bounce. Again, as most people end up being on the wrong side, you don't want to be with the crowd, where the crowd thinks. And of course, in the short term, big picture, different story. So getting down to some levels that I think the risk reward on a continued short is not the best. You've also got Powell, so you've got more uncertainty there. I think that, to be honest, it's not worth swinging. Even in the earnings season, it's not worth holding much. Just let things kind of do their thing, and then we'll hopefully have some opportunities on the backside of that and into November as we move on, and which is historically a pretty good month. December, pretty good as well. So in terms of upside, do we get that? We'll see. I think a lot of charts even have to still have work to do on the upside to be looking good again. Because we've seen just how far down we've kind of gotten. Like when I say looking good is like, you know, we got some lower high, like getting back to breaking some of the patterns, right? To making a downtrend break, or, you know, breaking out over a key level, right? There's not a lot of charts that are at those, that are like near these like prior resistance points. And so that's what I'm saying, is that you're going to need some bounce work to be done to get there, ideally. So it's not going to be like immediately everything is going great, we're back to swinging longs like nothing, but it doesn't take too long once you've seen we get some pretty big snapbacks. So with that said, that's where we are. Visit from Papa Powell. Yep. I'm gonna wrap things up. I did not trade today. So the trade recap from yesterday is where the account stands. We're very close to an October trade recap video, which will be good. I think a lot to take away from that. I'm looking forward to looking back through my data for this month. Kind of a interesting month where we moved from options to shares, and we went with the prop firm instead of trading on Webull anymore, which I like. There are some negatives though. It'll be a separate video that I'll make because it's more like a review of the prop firm that I want to do, because I have no affiliation with them necessarily at all. So I don't care. It's going to be like, here's what I did, here's what I did, and curious, like, oh, for someone in the future that might get something out of it. It's kind of tough just on like in a short. I have done okay. I'm 15% of the way to the profit target, but I'm not pushing pace. I'm not sizing very big at all. I'm actually sizing quite small for what normally I think a lot of people tend to do when they're on a prop firm, because they want to go on a little run, boom, 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 5 trades, hit their targets, and then get a funded account. That's just not good risk management to me, because, I don't believe that that's how you want to be operating. You want to be kind of operating the same way you've been, and then slowly size up as you can, as you have the capital and the experience, and then understanding of like where we are market condition wise. And this is not the market conditions, in my opinion, to be sizing up by any means. Definitely not. So either way, I'm happy with where I'm at there. Just slow, steady progress. And if we get a good month or two, boom, that could be a big enough move, and we can be funded in no time, in a month, for all we know. Just gonna be kind of moving the needle slowly. But I don't know if it's because they make you trade on a demo account, so you have to like make money on the demo account. In my case, on a 50K account, make $5,000 on a demo account first. But the spreads are pretty big. So yes, while you move away from option spreads, I like that better. I'll still take what I'm doing now over that. No theta decay, none of that shit. The spreads are cool, but they're big. But it makes it a little more. It makes it more challenging than it needs to be, and than it realistically is. Like, you can't set a limit order and expect to get filled until, if I put a limit buy in, we have to come down like the price literally has to go below where that order is, and in terms of the bid ask, and then the ask has to get down to that buy. And it might not sound like a big deal when you look at some stocks and they have like a 2-cent spread, whatever. But on the CFDs and the paper account that I'm trading, the spreads are at least 10% for all the stocks that I look at. At least 10 cents. Not a big deal, but some stocks, 20, 30 cents are common. Higher price stocks like a Netflix was one that I was watching. So the spreads are it's kind of a pain in the ass. Like, if you market buy in, like, you're buying in above, essentially. Like, they're filling you decently above, from my experience, where the actual price currently trades. Is it a big deal if you get the move you're looking for? No. You just have to adjust accordingly. So I see how, like, there was that whole scam on, I think it was My Forex Funds, how they scammed like people on their prop firm, and they were taking the other sides of trades, filling you at shit prices, all this stuff to essentially like make as much money and then fuck everyone over who tried to like sign up with them. And they did very, very well. And of course now they're getting fucked. But I see, like, they don't make it easy. Like, if realistically, if you just had a TD Ameritrade, even a Webull account, whatever platform you like the most, Interactive Brokers, whatever, if you had one of those accounts connected to TradingView, put a limit order in, like in between the bid and the ask, like, you might get filled, versus Like this thing, you're not going to get filled if you like buying the ask to get in and selling the bid to get in. And then they make those even bigger on the paper account. At least my experience. I don't know. It'll be cool to compare that to the live funded account. If it's the same, kind of shitty, because you can get slightly better fills. Not a big deal on shares. Not a big deal, but you can still get slightly better fills, which, little things add up. And it's kind of annoying how I'm almost at a slight disadvantage every single time, no matter what. Still will take that 1,000 times over options. But that's like my 2 cents. With that, I'm going to say goodbye. Peace out for the weekend. Have a great weekend. Hope everyone gets outside. I'm recovering from, actually, now it's COVID. Tested positive today. But feeling better. In a week, I have to run a 50K. A week from Saturday. So, hopefully, we are good for that. But get outside, do something fun.